Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday, everybody. This is James. We're back at it with 15 Minutes of Finance. Look, yesterday is usually when we do the episode, but I have been so sick. I sounded, I don't know, a horse or a frog was in my throat, whatever the term is. I had it all. I sounded like a gremlin, and it would not have been I didn't want to put you guys through it, but we don't miss episodes here. We just are a little late with them. So, guys, a lot to go through today. Me and Brandon had our episode of the week, Two Gents, 2 Cents, where we give you, we're two gents, we give you our 2 cents. We really went deep into working with advisors and our different experiences. And I promise you, the episode's a little long, but I promise you it's totally worth a listen. You will learn something, and you will be either shocked or you'll nod your head and go, oh yeah, like that totally makes sense. And then today, guys, I'm going to go over a little deep dive, secret insider information for you about how I design our portfolios at the firm, and our thought process and what we do and what we don't do in comparison to other firms that make us a little different. And if you manage your own portfolio, I hope you learn something from this, okay? Because this is definitely, I'm going to try and keep it simple and sweet, and this is definitely something you can take to the table next time you're with your smart friends or your day traders, and you could throw out some terms and maybe sound a little bit smarter than you are, but you actually are going to get smarter. So, okay, first we're going to talk about behavioral finance terms today. So the term of the day is confirmation bias. Now, behavioral finance, that just has to do with your relationship to the money, right? So are you an emotional investor? Are you a tactical investor? Do you know every single penny that comes out of your investments or your cash flow or your income? Or are you more of like a separate, I kind of know what my budget is, but I understand that I'm not overdrawing or I'm not leaving money on the table, etc. So confirmation bias is when investors have a bias towards accepting information that confirms their already held belief in an investment. If information surfaces, investors accept it readily to confirm that they're correct about their investment decision, even if the information is flawed. I wanted to talk about this because confirmation bias is probably the number one thing that I see with conservative investors. So if we have a client, and I have a client that fits this stereotype perfectly. We met back in July as a married couple. Wife is like, hey, let's go. I'm aggressive. She's a CPA, so she's a little bit more aware of how things work, but she's like, let's go. Gung-ho, aggressive. We've got 10, 15 years for this money. We want it to grow. And the husband is more like, the end of the world is coming. We need to hoard our wealth, put it all into gold and silver, and get the water jug and the well dug up at our property out in the boonies. And so he has confirmation bias. He absolutely does. Anytime he hears something negative, he thinks that that's it. It's dooming his portfolio. And I have to tell you that a lot of advisors' jobs is behavioral finance. Now, we do a really good job of saying, hey, that's not all we do. I don't really like that side of stuff. The way I explain it is, look, I'm going to be a great surgeon. Like, I'm going to take care of you as best I physically can, but I'm not going to baby you in the post-op or pre-op. Like, I want to know, all right, X, Y, and Z about you. Let's get to it. Let's get the surgery done and make sure you're taking care of the best you are. That's really what you want in a financial advisor, an investment manager, or even a doctor. But what people tend to do is they tend to really like the doctor with the best bedside manner. Oh, like, how are you? Oh, yeah, tell me about your kid's college graduation. Like, that's what people like because it's just friendly. They like it. But I can tell you with experience, extensive experience in the medical department, every single person in my family is medical. That's the people that tend to be like that tend to be the worst surgeons. Okay, they put a lot of their effort into the bedside manner and not actually a lot of it into the surgery. So I do my best to be a balance of both, right? So with this guy, he was an engineer type. I just told him, I said, look, let's do 10% of your money aggressive. Okay, and this was back in July. And we'll do the other 80, 90%. We'll do it pretty conservatively, and you can just see the difference, right? Well, now at the end of the year, obviously that 10% has done really well because the market's done really well, and we were even more heavily invested in the sectors that did well, that did better than the S&P 500. So now we have to have a conversation with him about, hey, remember how you felt X, Y, and Z? Look, that it's valid, but that's only valid for volatility, meaning it doesn't really matter until you take the money out. So he is worried about the ups and downs and the the Armageddon of the world, but in reality, your portfolio will not matter if those things happen. So let's treat your portfolio with actual intention and growth mindsets to get your money to where it is. And if the doomsday does happen, you'll be worried about water. You're not worried about your portfolio. So that's a conversation we have to have quite a bit. And I'm going to go into, like I said, I'm going to go into the top 5 most important things that I think of whenever I meet with a client. And then we'll also go over another term called beta, which is if you want to use this at your table and you talk about the beta of a portfolio, I promise you'll sound smarter than 90% of the people at that table. Okay. But let's go into the news real quick. Okay. So where are we? Oh yeah. Perfect. Okay. Stocks put in a mixed performance Friday as investors digested inflation numbers that reinforced expectations the Federal Reserve will continue cutting interest rates, while a decline in shares of AI investor favorite NVIDIA led a broad sell-off for chip makers. The Dow Jones Industrial Average added 0.3% to close at record high, while the S&P 500 slipped 0.1%, and the Nasdaq Composite, which was riding a 4-day winning streak, fell 0.4%. Major indices were coming off solid gains on Thursday that were sparked by a rally for chip stocks and a big jump for companies with exposure to the Chinese economy amid news of stimulus measures. The U.S. stock market has recovered from an early September sell-off as investors are optimistic that the economy is headed for a soft landing and that the Fed will continue easing rates after it reduced the influential Fed funds rate last week for the first time in 4 years. Major indices are on course to finish higher for the month after another week of gains. Okay, great. I mean, that's fine news. Yeah, Friday, the stock market fell off a little bit. At least the S&P did. That's what I like to use. And then Thursday was a great day. I mean, I remember Thursday hitting, and I was like, wow, like this is crazy. There's no way there's not going to be a drop off. Like, how does it keep going higher? And then I remember that my forecast for next year is like 7,000. So we still have another 1,200 points. And I still think it's going that way. Again, I think there's going to be volatility, but that doesn't matter to you unless you sell. Okay. Volatility. It's emotional. It's a behavioral finance, factor, but it does not actually matter in your portfolio. Okay. Those are the important things I want you to remember. Okay. Yes, it's possible doomsday happens. But if your portfolio, unless you're taking income off of it and living off of it and you need consistency, your portfolio should be growth. It should be. That is my opinion. It's my professional opinion. Unless there is a need for income, or I suppose you just want to leave a nest egg for your kids. I'm trying to think of another reason why you wouldn't want it growth. But, I mean, there's probably something I'm not thinking about. But let's go real quick into, I want to talk about what everything has done year to date. So S&P 500 has done 20.8%. Okay, that's really, really good. The average is like 10.23 or 10.5 or something like that for the S&P 500. And technology, which I would have guessed would have been number 1, is number 2 at 28.1%, and utilities are number 1 at 28.7%. And then it's comm services, communication is third at 26.5, and then financials, that's the biggest drop off between 3 and 4, is at 22.2%. So the S&Ps, as far as sectors go, isn't 5 on the list, which is, I mean, still great, totally great. Pretty much everything has done very, very well this year. If I look at last place, it's energy at 8.4, and then materials is second to last at 11. So still higher than the average. Excuse me. And I bring this up to just tell you that it's when the market does well, pretty much everything tends to do well. Okay, almost everything. What's really cool about this though is that still in the S&P 500, the top like 15, 20 companies are bringing it up. So when the other 480 rebound, the market has more room to go, has more glass ceilings to break through. So that just consider that when there's volatility, you might want to jump in. Okay. I want to talk about, before I talk about the 5 things, I want to talk about beta real quick. So when you hear the term beta, it's a Greek alphabet letter, but in finance, I want you to think volatility. Okay, beta, volatility, volatility, beta, beta, volatility. You will, when you're comparing two investments, so for example, we'll do tech stocks versus the S&P 500. When you have a beta, okay, we'll just say it's a beta of 1.5. That means that your portfolio, your portfolio is the tech portfolio, is 50% more volatile than the S&P 500's is. So if yours is at 1.5 and the S&P 500's at 1, then you're 50%, 1.5 to 1, more volatile than the S&P 500. And you can only use this in comparison. Like a portfolio by itself doesn't have a beta of anything. It has to be compared to an index or another investment. And the betas are used relatively to compare risk. Okay, it's risk. So you would say, oh, it's 50% more risky. And I mean, risky is not quite the right term, but you would say that it's 50% more likely to go up or down than the S&P 500. So it's volatile. And the S&P 500 is usually a 1, right? You're usually comparing it to like the Dow, the NASDAQ, etc. And so when you're having a beta of 1.5, I would say as an investor, I'm like, oof, that's going to be hard to sell to a client because there's going to be a lot of volatility with that. A client's going to have 20% drops and 20% gains either way. And I can tell you almost universally, when clients have 20% up, they don't want to sell. But when it's 20% down, they do want to sell because it's behavioral finance. They have confirmation bias. They think something's going to happen that they've read or heard that's probably not going to happen. And even if it does happen, it's probably temporary, right? Most market corrections happen within 18 to 24 months of the market recession or downfall. So the beta is a risk measurement, a volatility measurement of a index or investment comparison to something else, which in this case for us is usually the S&P 500. One of my favorite tools in measuring a portfolio, because I know volatility is the most important thing, even though clients might say, oh, I can deal with the ups and downs. Almost universally, it is really tough for them to deal with it. Okay, so now into the goods, right? So the 5 most important things when I'm thinking of a portfolio for a client, I consider these 5 things, okay? And I want to just reiterate, which I talk about often, most advisors are not actually picking the investments in your portfolio, okay? They are hiring an outside firm and charging you a fee for that. So now you're paying 2% assets under management fees, 2% of assets to 2 people, one of them who's acting like they're making choices when they're really not. And then the other person could be in Taipei or Hong Kong or New York City in a penthouse making these choices in their pajamas, and you'd have no idea, okay? So rate of return for me is the most important thing when it comes to designing portfolios. I want a good rate of return. Now, this is all in comparison to a client's risk tolerance, right? If someone who's 75 and taking income, they don't need 10%, right? Maybe they need 6, maybe they need 5, maybe they need 2, okay? And we wouldn't charge the same fee to someone in that position as we would to a 35-year-old with $1 million who's like, I want to grow this money. Those fees are different. Most advisors don't do that. They say, you want to work with us, the fee is 1.5%, okay? And what that 1.5 covers is maybe like 0.75 to them and 0.75 to an asset manager. But you're 75, right? You just need income. Well, now you're getting a erosion into your rate of return because you're paying a fee. Okay. Make sure you guys know these things. Who's actually making decisions in your account? And if you do your own investments, You got to make sure that you have your emotions aside from it. Get your emotional bias out of there and look at these 5 things when deciding what to invest in and how to invest in and whatnot, and compare everything to risk tolerance. Okay, these are the 5 most important things that we look at. One is your time horizon. Okay, that to me is more important than anything. Do you have 10 years, 20 years, 3 years, 5 years, 40 years? Okay, the longer the time you have, the better and less stress you should worry about anything going on. Okay, you should dump dollar cost average amounts of money into your accounts and don't even worry about it. Okay, especially if you're, I don't know, like say you make $80,000 and you're just putting money in your 401k. I would tell you be in the most aggressive fund you can. And this is assuming a general, right? This isn't specific financial advice, but I'm just giving you a general picture of a fictional person. 80 grand a year, you have 40 years till you retire. We'll assume 62. And so you're 22 and you're just putting away 10% and you're getting a 6% match. Be in the most aggressive fund you can and don't worry about it. Okay. You'll have millions of dollars by the end of it if you do this. The aggressive fund should get more than the S&P, which is 10%, 10.2%. Okay, so time is the number one most important thing, right? If you have 5 years left, you should invest differently than if you have 40 years left. That makes sense pretty much to everybody. The shorter the time, the less beta you want, right? You don't want the ups and downs. You want a consistent, measurable rate of return. Okay, the next, speaking of rate of return, is rate of return. And I learned this from my previous job. Steve, he was an excellent portfolio designer. He was a CIMA, which is, other than the CFA, it's the number one portfolio design designation. And we'll be getting that in our firm here in the next year or two. But rate of return is one of the most important things to a portfolio. Okay. If you look at a future value calculator, year 5 will probably have a very small rate of return in comparison to the principal amount, but year 30 will have 5, 10, 20, 30x of the principal amount. The rate of return will be significantly higher because over the years, rate of return is what matters the most. That's where you're going to get most of your income from. And it's not going to be from your principal. Okay, so rate of return, very, very important. Okay, it's very important. Excuse me. Third is timing, okay? And timing kind of goes into time horizon, but it's a little bit different. So if you have 5 years and you want to invest, I would tell you not to invest at the all-time highs, okay? I would tell you right now, hey, you need to wait. I'd put it in a CD or a treasury or something, and the second we get a 10% drawback, then you should jump in, okay? Because what's most likely going to happen is if you do it now, yeah, sure, it'll probably be higher in 5 years no matter what, but you might see a 10% erosion immediately. If there's, we have a volatile period of time coming up here in Q4 with the election, okay? Who knows what's going to happen? Now, I think 2025 is going to be great. I think it's going to be a good year, but we don't know what's going to happen in the midterm, right? In the meantime. So you want to be wise in when you time an investment. It's not easy to do. I would say that's probably the hardest one. Timing is most of it is subjective. You've got to decide when to jump in and when to jump out. Okay, next is your principal amount. Obviously, if you've got 10 years and you put $1 million in year 1, you're going to do better than someone who puts in $800,000 that has the exact same time horizon as you. So principal, the amount you put in, again, it's still not as important as time or rate of return. It's just not. The amount of money you put in isn't as important as those things. And then contribution amount. Principal and contribution amount can be flipped, 4 and 5, doesn't really matter. It's good. You're saving, you're contributing, but again, it's more important to have a lot of time, so to have started earlier, and that you have a great rate of return. Those are the things that matter. Okay, so guys, look, I am almost 5 minutes over my 15 minutes of finance limit, which is not good. I got to keep my word and keep this to 15 minutes. But I hope that gave you some insight. Okay, you guys got confirmation bias, beta, time, rate of return, timing, principal, contribution amount. You guys got a lot of stuff today. Okay. When you're making these investment picks, remember, you might get 20% this year, but next year you might get -7. Okay. It's all about the length. It's about the marathon. It's not about the 1 mile you ran. Remember that. It's about the length. It's about the endurance, the whole journey. And look, if you guys don't have a financial advisor and you want one, please interview. I think it's something like 50% of advisors now don't manage their own investments. Everything they do is basically counseling and just babying you, right? Helping you along. Okay, they don't actually make any investments. Someone in New York City or Taipei is doing your investments. You don't want that. That's more hands in the pot, and that's less money in your pocket. Okay, guys, I'm way over my time. That is it. As always, invest early, invest often. We'll see you next week.